Hey guys, this your girl Sue here. Stop scrolling. This might be the most important SoFi update you'll hear this week. Institutional ownership in SoFi just hit new highs, and the filings back it up. In the latest quarter, Jane Street added 6.49 million shares. Quadrature Capital added 6.33 million, and UBS Group added 5.92 million. That's not retail noise. That's systematic money building a position. Here's what tipped me off. Every quarter, we get 13F snapshots. Most are small trims. This time, the ads were chunky and deliberate. Roll that into the bigger picture and the signal gets louder. Over the last 12 months, trackers show $2.19 billion of institutional inflows versus $1.31 billion outflows, with 510 buyers versus 274 sellers. Net, more dollars, more buyers, stronger hands. Why would funds load now? Let's connect numbers to narrative. SoFi path to consistent profitability tightens the model. Less story, more cash flow. With a bank charter, deposit costs trend lower as rates normalize, bolstering net interest margins. On the tech side, Galileo Technisys expands fee revenue, exactly the kind of mix shift institutions pay up for. When both engines push, lending plus platform, funds can justify multi-quarter positions, not just trades. What happens to price when ownership hardens? Watch the tape. When stronger hands accumulate, down days often print lighter volume while up days carry heavier volume. Recently, we've seen precisely that profile. Green sessions with meat on the bone, red sessions that look like exhale, not capitulation. That's accumulation behavior. It doesn't guarantee straight up, but it changes the odds around key levels. Let's map the path in real levels you can track. First, the last failed breakout zone. If institutional bid is real, that resistance tends to flip to support on the next test. Second, the round number magnets where options open interest clusters. When calls stack and dealers hedge, it can mechanically pull price toward those strikes. Your checklist, rising ownership, defended prior highs, expanding green day volume, options, open interest crowding higher strikes. Risk doesn't vanish just because funds are in. Two numbers I'm watching like a hawk: delinquency rates in the loan book and tech platform revenue growth. If delinquencies rise without margin offset, the bid pauses. If platform growth underdelivers, the multiple won't stretch. Score the next earnings print on three metrics: revenue mix, net interest margin discipline, OPEX per member. If those trend right, accumulation usually continues. If they wobble, expect a retest of the prior support zone. Zoom back out. New highs in institutional ownership aren't an accident. They're a vote for trajectory, not perfection. With 6.49 million from Jane Street, 6.33 million from Quadrature, 5.92 million from UBS, and a plus 880 million net inflow picture over 12 months, the market is telling you who's holding the wheel. When catalysts hit, earnings, guidance, rate moves, stocks with locked-in float don't just pop, they can sustain moves. No hype, just the numbers and the tape. If this helped, hit that like button so more investors see it. Drop your target zone in the comments. I'll pin the most data-driven take. This is not financial advice. Always check out with your financial advisor. This is the framework I'm using while institutions keep turning the dial up on SoFi. Ciao.